Something is breaking, but not in the way people expect. It's not loud yet. There are no emergency press conferences, no flashing banners across financial television. What's happening is quieter, more mechanical, and far more dangerous because of that. Systems don't fail when everyone panics. They fail when stress accumulates silently and incentives shift underneath the surface. Right now, the global financial system is experiencing a stress fracture, not from speculation or emotion, but from arithmetic. The numbers no longer reconcile. Prices that are supposed to converge are moving apart. Assets that are supposed to be interchangeable are no longer treated that way. When that happens, markets stop behaving like markets and start behaving like extraction engines. Silver is the clearest example of this breakdown. In theory, an ounce of silver is an ounce of silver anywhere on Earth. Geography should not matter. Logistics should account for minor differences. Arbitrage should close gaps quickly. That is how a functional global market operates. But today, that mechanism is failing in real time. In Western paper markets, the quoted price has been driven down aggressively. On screens, it looks like collapse. It looks like a failed rally. It looks like the story is over. But that price is increasingly irrelevant because it is disconnected from where actual metal is being demanded and delivered. Across the Pacific, the same metal trades at a dramatically higher level. Not marginally higher, structurally higher. High enough to override shipping costs, insurance, time, and risk. That spread is not a rounding error. It is a signal. When a commodity trades at a persistent premium in a delivery-based market relative to a paper-based one, the message is simple. The paper price is no longer trusted to clear physical demand. That is not a temporary distortion. That is a regime change. Once that threshold is crossed, flows change direction permanently. Metal does not move where it is cheapest. It moves where it is valued most. That valuation is expressed not in opinions, but in bids that clear inventory. Refiners, wholesalers, and logistics firms do not care about narratives. They care about margin. When faced with two buyers, one offering significantly more for the same product, there is no debate. The metal goes east. That decision repeats thousands of times across the supply chain. Each repetition drains inventories that were already thinner than reported. Western vaults were never designed to withstand sustained physical outflows because they relied on net settlement and paper substitution. Those assumptions are now failing. This is why attempts to suppress the quoted price backfire. Lower prices do not reduce demand in a physical shortage. They increase it. They accelerate the drain. They turn every bar into a discounted asset for buyers who understand the discrepancy. Price suppression only works when supply is abundant. When supply is constrained, it becomes an accelerant. That is the mistake being made right now. At the same time, the currency used to denominate the paper price is weakening. This compounds the problem. A falling dollar does not stabilize markets. It distorts them. As the dollar loses purchasing power relative to other currencies and real goods, assets priced in dollars appear volatile even when their real value is stable or rising. This creates confusion for domestic investors and opportunity for foreign ones. Foreign buyers are not focused on nominal dollar charts. They are focused on real acquisition cost. From that perspective, silver has never been cheaper. This is why capital is moving quietly but decisively. Sovereign buyers, industrial consumers, and long-term allocators are not debating headlines. They are executing procurement. Procurement does not reverse easily. Once supply chains reorient, they do not snap back overnight. This is what makes the current situation dangerous for paper markets. Paper markets require confidence that claims can be settled. Physical markets only require delivery. When delivery demand overwhelms paper capacity, the system must choose which obligation to honor. That choice is rarely announced in advance. Instead, it shows up as rule changes. Margin requirements increase, position limits tighten, settlement terms adjust. Language around exceptional conditions appears. These are not signs of stability, they are containment measures. Raising margin requirements is not about protecting investors. It is about forcing liquidation. It is about reducing exposure without addressing the underlying imbalance. Forced liquidation creates downward pressure on quoted prices, but it does nothing to increase supply. In fact, it worsens the shortage by discouraging new paper participation while leaving physical demand untouched. Industrial buyers do not use leverage. Sovereign buyers do not respond to margin hikes. They pay cash. They take delivery. So the burden of these measures falls entirely on speculative participants, not on the entities driving the physical drain. This creates a false signal. Screens show weakness while inventories vanish. That divergence is the most important signal in any commodity market. When price action contradicts availability, price is lying. History is clear on what happens next. Either the quoted price resets upward violently to ration demand, or the market fractures into separate pricing regimes. Neither outcome is friendly to paper holders. This is why messaging becomes aggressive at this stage. Narratives are deployed to discourage participation. Liquidity myths are repeated. Volatility is framed as danger rather than opportunity. The goal is not education, it is deterrence. If participation can be reduced, pressure eases. If pressure eases, time is bought. Time is the only remaining asset for a system under constraint. But time does not create supply, it only delays repricing. Meanwhile, physical realities continue to assert themselves. Refiners report backlogs. Wholesalers ration orders. Premiums rise even as spot prices fall. That is not contradictory, it is diagnostic. Premiums are the truth. Spot prices are the advertisement. When premiums expand persistently, it means the advertised price cannot clear real demand. This is not a retail phenomenon. Retail shortages are visible but small. The real stress is upstream, where 1,000-ounce bars move between institutions and governments. That market does not care about sentiment. It cares about certainty of access. Access is becoming asymmetric. Once access becomes asymmetric, pricing power shifts. Pricing power does not migrate gradually. It flips. Markets rarely warn before that flip because doing so would accelerate it. Instead, they rely on participants to ignore structural signals in favor of familiar narratives. That works until it doesn't. At that point, repricing is not negotiated. It is imposed, and it happens fast. This is why the most important decision right now is not tactical. It is structural. It is about which system you trust to clear obligations under stress. Paper systems promise convenience. Physical systems guarantee control. When trust is abundant, convenience wins. When trust erodes, control dominates. We are in the transition between those states. Nothing dramatic needs to happen tomorrow for that transition to complete. It only requires continuation of current conditions. Continuation favors the drain, and drains do not reverse until the source is exhausted or the price adjusts enough to stop the flow. We are not close to that adjustment yet. What makes this moment especially dangerous is that most participants are looking in the wrong direction. They're watching charts instead of inventories, headlines instead of flows, opinions instead of incentives. Markets don't break because people panic. They break because mechanisms stop working quietly while everyone is distracted by noise. The mechanism that's failing right now is price convergence. For decades, the assumption was simple. If prices diverge too far, arbitrage would fix it. Buy low here, sell high there, profit closes the gap. That only works when paper promises are trusted substitutes for physical delivery. Once that trust erodes, arbitrage stops being a stabilizer and becomes an extractor. That is exactly what's happening now. The spread between paper pricing in Western markets and physical delivery pricing in Asia is not narrowing, it's persisting. That tells you arbitrage is no longer flowing capital into balance. It's flowing material out of the system. Every bar that leaves a Western vault to satisfy higher price delivery elsewhere is one less unit backing the paper claims, still trading domestically. Those claims don't disappear. They stack. They rely on rollover. They rely on confidence. Confidence is the only collateral paper markets truly have. Once confidence weakens, leverage becomes toxic. That's why exchanges react with margin increases. They are not managing risk. They are reducing exposure to a future they can't control. But margin hikes don't solve shortages. They only change who is allowed to participate. The result is predictable. Speculators are forced out. Volatility spikes. The quoted price drops. Commentators declare victory or defeat depending on their bias. Meanwhile, the metal keeps moving in one direction. This is how systems fracture. What's often missed is that physical buyers are insensitive to price in the short term when supply security is at stake. Industrial demand does not pause because charts look overextended. Strategic stockpiling does not stop because RSI is high. Those buyers operate on time horizons measured in years, not candles. When access becomes uncertain, price becomes secondary. That's why premiums rise independently. That's why delivery delays lengthen. That's why settlement terms tighten. These are all symptoms of the same condition: inventory stress. Inventory stress is the one variable paper markets cannot fabricate indefinitely. You can rehypothecate paper, you can net settle obligations, you can extend delivery windows, but you cannot deliver what you don't have. Eventually, claims collide with reality. At that point, one of two things happens. Either price is allowed to rise until demand is rationed, or the market admits it cannot perform its core function. Both outcomes end the same way for paper holders. This is why narrative control becomes critical in the late stages. If participation can be discouraged, pressure eases temporarily. If enough people believe the move is over, fewer demand delivery. That buys time. Time is the only remaining objective. But time is not neutral. Time favors the entity accumulating physical supply while others hesitate. This is why the geopolitical dimension matters, even if it's not explicitly stated. Resource security has replaced yield as the primary concern for major players. You don't need conflict headlines for this shift to occur. It's embedded in procurement decisions. A nation with surplus currency but limited resource access will always choose to convert paper into atoms when given the opportunity, especially when that paper is losing value. This is not ideology, it's arithmetic. Currency depreciation changes behavior long before it changes official policy. By the time policy responds, flows are already entrenched. This is why watching currency indices alone is insufficient. A currency can appear stable relative to other fiat while losing ground against real assets. That distinction is lost on most observers. Markets price relative value, not absolute truth. Silver sits at the intersection of this misunderstanding. It is both a monetary asset and an industrial input. That dual role creates tension when currency confidence weakens. Monetary demand accelerates. Industrial demand does not retreat. Supply cannot respond quickly because most production is secondary. That asymmetry is structural. When demand increases on both fronts and supply is inelastic, price must eventually adjust upward. If it doesn't, allocation occurs through availability instead. We are currently in that allocation phase. Metal is not being allocated by price, it is being allocated by access. Access favors buyers willing to pay premiums and take delivery without leverage. This is why price suppression strategies fail over time. They address optics, not physics. Physics always wins. Every ounce removed from circulation tightens the system further. Each tightening increases sensitivity. Sensitivity leads to instability. Instability forces resolution. Resolution does not arrive politely. This is why those watching for a clean breakout signal will miss the move. Repricing under stress does not respect technical levels. It jumps them. The market does not ask permission to reset. It does so when pressure exceeds tolerance. Tolerance is lower than advertised. This is evident in how quickly rules are changing. Stable systems do not rewrite margin requirements mid-cycle. Confident systems do not need to reassure participants through media proxies. These are defensive behaviors. Defensive behavior indicates awareness of vulnerability. What's striking is how asymmetric the risk now is. Downside in physical holdings is limited by scarcity. Upside is uncapped once repricing occurs. Paper positions face the inverse. This is not an investment pitch. It's a structural observation. Those holding physical metal are not exposed to counterparty failure. They are exposed only to opportunity cost. Those holding claims are exposed to system behavior. System behavior under stress is not predictable. It is political. That alone should reframe risk assessment. The next phase does not require a catalyst. It requires continuation. Continuation of inventory drawdowns, continuation of currency weakness, continuation of premium divergence. If those persist, repricing becomes inevitable. The timing is unknowable. The direction is not. This is why preparation matters more than prediction. Positioning matters more than timing. Those who wait for confirmation will receive it at a price they no longer recognize. Markets do not reward certainty seekers in regime shifts. They reward those who act when signals are ambiguous but aligned. The alignment is clear now for anyone willing to look beyond screens. What happens next will feel sudden only because most people refuse to see it developing. The mistake people make in moments like this is assuming that visibility equals importance. They focus on what is loud because loud feels urgent. But in financial systems, the most dangerous shifts are almost always quiet. They happen in inventory reports, settlement delays, bid behavior, and changes in who is willing to transact and under what conditions. Right now, the most important signal is not volatility. It is persistence. If this were simply a speculative spike, the spread would collapse quickly. If this were just noise, premiums would retreat. If supply were sufficient, delivery timelines would normalize. None of that is happening. Instead, we are watching a steady, disciplined extraction of material from a system that assumed it would never be tested at the physical layer. That assumption is gone. Once that layer is tested, everything above it becomes optional. This is why paper-based explanations are no longer useful. You cannot model your way out of a shortage. You cannot hedge your way out of an inventory drain. You cannot narrative your way out of a trust problem. You either have the asset or you do not. This is why forced selling events are not bearish signals in constrained markets. They are redistribution events. They transfer exposure from leveraged participants to those with balance sheet capacity and patience. Every margin-induced liquidation removes weak hands without creating supply. The metal does not vanish. It moves. That movement is directional. Directional flows do not reverse until incentives reverse. Incentives are not reversing yet. The premium structure tells you that. Delivery behavior tells you that. Refining throughput tells you that. Currency dynamics reinforce it. The dollar's role here is critical, not because of ideology, but because of arithmetic. When the unit of account weakens, pricing mechanisms distort. Nominal prices rise, but real access tightens. This creates the illusion that assets are volatile, when in reality the measuring stick is unstable. That illusion traps participants who believe stability is returning because charts flatten temporarily. They mistake consolidation for resolution. Resolution requires balance. Balance requires supply. Supply is not returning. This is why strategic buyers continue accumulating regardless of short-term price action. They are not optimizing entry, they are securing access. Access is the scarce commodity. Once access becomes scarce enough, price becomes whatever clears the marginal buyer. At that point, historical anchors are irrelevant. Markets do not care what something used to cost when it becomes essential. They care what it costs now to obtain it. That distinction is uncomfortable because it invalidates models built on mean reversion. Mean reversion assumes elasticity. Scarcity destroys elasticity. This is not theoretical. It is observable. The refusal of physical markets to respond to paper weakness is the clearest confirmation that elasticity is gone. When price falls and demand rises simultaneously, the system is broken. Broken systems do not heal themselves. They reset. Resets are not negotiated evenly. Those closest to the asset benefit first. Those farthest away experience repricing last. Distance here is not geographic. It is structural. If your exposure depends on intermediaries behaving rationally under stress, you are distant. If your exposure depends on delivery promises, you are distant. If your exposure depends on rules remaining unchanged, you are distant. Closeness is simple. It is possession and control. This is why transitions feel unfair. They are not democratic. They are mechanical. Mechanics reward preparation. Preparation does not mean panic. It means alignment with reality. Reality right now is telling you that abstraction is being discounted. Physical certainty is being repriced upward even if screens do not reflect it yet. That gap cannot persist indefinitely. Either the screens catch up or the system fragments. Fragmentation is not chaos. It is segmentation. Different prices for different participants, different rules for different actors, different outcomes based on access. We are already seeing the early stages of that segmentation. Some participants are paying premiums without hesitation. Others are arguing about charts. That alone tells you who understands the game. This is not about belief. It is about behavior. Behavior reveals priorities. Priorities reveal risk assessment. Those accumulating physical assets are not speculating on price. They are hedging against system behavior. System behavior is increasingly unpredictable. Unpredictability increases the value of assets that do not require interpretation. This is why confidence will not return simply because volatility subsides temporarily. Confidence requires trust in structure, not calm in price. Structure is still strained. Until structure stabilizes, repricing pressure remains. This is why waiting for confirmation is dangerous. Confirmation arrives after repricing. Those who wait for clarity receive it when options are limited. Those who act when signals align receive flexibility. Flexibility is the real advantage. The market does not care who is convinced. It cares who is positioned. Positioning quietly now avoids urgency later. Urgency is expensive. This is not a call to act impulsively. It is a call to recognize that the system is communicating through incentives, not announcements. The communication is clear. Metal is flowing one way, currency is weakening, paper controls are tightening, physical access is narrowing. These are not independent phenomena, they are connected. They represent a transition from trust-based pricing to constraint-based pricing. That transition is always uncomfortable because it exposes assumptions people did not realize they were making. But discomfort is not danger if you are aligned. Danger is clinging to assumptions that no longer apply. The world is not ending, it is adjusting. Adjustments favor those who understand them early. This moment will be remembered not for the headlines, but for the quiet reallocation that took place before headlines caught up. Those who participated will not need to explain themselves later. The outcome will speak for them. Everyone else will ask how it happened so quickly. It did not. It was happening the entire time. And now you know where to look.